Melbourne house prices are bucking the national trend, recording a fifth straight month of decline.
Melbourne's rental vacancy rate has collapsed to 1.1%.
Times are tough for investors trying to offload units and apartments here in Melbourne.
Jess Wilson is pitching a two-pronged offensive to address the state's housing crisis.
As Labor sets its sights on rail, the opposition is pivoting to housing, pitching what they claim is a fast-track housing fix.
The Liberal Party wants to extend our city limits and fast-track new estates in Melbourne's outer suburbs.
A return to a policy setting that effectively led us to the crisis that we're now in.
Conditions are not very favourable to building apartments.
Melbourne apartment owners are already trapped. Across Victoria and across Australia, thousands of apartment owners are now in buildings where the repair bill is approaching or even exceeding the value of the apartment itself. That means many owners are not sitting on an asset anymore. They are sitting on a financial liability. The brochure promised low-maintenance city living. The data delivers buildings where owners are being asked to pay enormous sums just to keep them standing. That is not a normal market correction. That is a trap you walk into thinking you bought security. Once you see how this happened, you will understand why thousands of apartment owners are suddenly unable to sell at anything close to what they expected. This is what trapped actually looks like. It is not a bad month of strata fees. It is a moment when the body corporate calls for an extraordinary levy. It is when an engineer report lands and the numbers are catastrophic. It is when insurers hike premiums, lenders tighten and valuers cut hard. It is when a building repair bill is so large that no reasonable buyer will take it on. You can list your unit, you can cut the price. It still goes nowhere because the buyer is not just buying four walls. The buyer is buying future levies, unknown risks, ongoing litigation, and the building reputation. Here is the plain language. Temporary repairs are one thing. A financially broken building is another. Temporary repairs are roof patches, short membranes, a lift motor swap. A broken building is systemic failure. It is cladding that fails tests, structural concrete cancer, widespread water ingress that has soaked the slab, non-compliant fire systems, failing balustrades, and membranes that require full replacement. Engineers may recommend remediation that involves scaffolding for months and invasive works across the entire structure. That is a category error. The market treats that differently. The insurer treats that differently. The bank treats that differently. The valuer treats that differently. When the repair cost exceeds what the apartment will realistically sell for, the market closes, not because of sentiment, but because the arithmetic is fatal. Melbourne is particularly exposed. This is not random. Melbourne has a massive volume of apartments concentrated into corridors and precincts built at scale during boom cycles. Many of those towers were investor-led developments with thin owner-occupier depth. That matters because owner-occupiers anchor local demand and create market resilience. Where the cohort is overwhelmingly investors, the property price depends on yield and sentiment. When yields are squeezed by higher strata fees and special levies, investors have little tolerance. Oversupply in certain corridors means buyers can choose another building without the stain of defects. Generic mass-produced apartments have no unique appeal to offset a major levy. The economics flip fast. A building that once looked like a cheap entry point becomes the most dangerous asset on the block. The data is already brutal. Independent research has found more than 3,400 defective apartment buildings across Australia, with an estimated $6.2 billion in rectification costs. Studies of apartment buildings in Victoria have found that a very high share of recent buildings have significant defects, and hundreds of them require serious cladding and non-cladding remediation that owners must fund. That is the point at which the levy arithmetic starts to kill liquidity. It is the moment when banks start asking for additional security or simply refuse to refinance. It is when valuers apply a discount or refuse to certify market value. One owner may be told to find $50,000 now. Another sees $120,000. Another is handed a multi-$100,000 remediation plan. Those bills do not arrive in gentle installments. They arrive as special levies or staged calls that can hit hundreds of owners at once. Collective risk becomes collective ruin. When a levy lands, the sale price does not just fall a little. It gets capped by the cost of solving the building problem. Imagine a buyer trying to value an apartment where the next scheduled levy is $80,000 per unit and the market comparable is $500,000. The rational buyer subtracts risk and future cost. They will not pay the comparable price when they will be immediately liable for a share of an $8 million repair bill. Instead, offers stagnate in the low range. Price cuts do not instantaneously fix the problem because the buyer still factors in unknowns. They think about additional defects that may show up, litigation timelines, insurance disputes, and the likelihood of further levies. That is why apartments can sit on the market for months and still go nowhere. Who gets hit first? The pattern is predictable. Off the plan, buyers who purchased at peak prices are often the most vulnerable because they paid top of the market with minimal buffer. They bought a future they cannot easily sell. Investors in standard one-bedroom and two-bedroom products are next. These are commodities in the eyes of the market. Add a levy and the investor arbitrage collapses. First home buyers using an apartment as an affordable entry into Melbourne find themselves in a brutal trap. They have a small deposit and huge ongoing liabilities. Owners in buildings with repeated defects, ongoing water problems, or a history of short-sighted patch fixes are the most exposed. They are living inside a slow insolvency process where the building accumulated neglect is enforced on owners all at once. Consider the dominoes. One building publicly calling for an $8 million remediation program creates headlines. Agents in that suburb start to add cautionary notes. Buyers begin to interrogate strata minutes. Lenders quietly tighten appetite for apartments in the area. Valuers apply higher discounts. Listings that previously achieved multiple bids now languish. This fear migrates to neighboring buildings. Buyers generalize the risk. Sales volumes drop. Prices compress. For developers, future approvals get harder. For existing owners, the only liquidity that remains is at fire sale levels. That contagion is not hypothetical. It repeats in cycles. A single high-profile broken building can poison an entire precinct pricing for years. The mechanics of the trap are worth spelling out clearly, because the alternatives owners are being pitched are often illusionary. The common solutions sold by committees or councils are to defer works, to use staged remediation, to rely on complex remediation bonds, or to pursue legal challenges to contractors. Those can delay pain, but they rarely remove it. Deferring works increases the ultimate cost as damage compounds. Staged remediation spreads cash calls over time, but keeps risk alive longer, and often increases interest and management fees. Litigation drains funds, adds legal uncertainty, and delays resolution, which in turn extends the period where buyers are reluctant. Then insurers play their part. Insurance within multi-unit schemes is a fragile channel that can be cut. Once an insurer flags a building as high risk, premiums spike. Some insurers will refuse to renew. When that happens, the body corporate is forced to shop the risk, often landing on an insurer charging multiples of the prior premium or requiring higher excesses. High premiums feed special levies. Banks see higher insurance risk and raise lending standards. The triangle of insurer, bank and valuer tightens. The apartment passes from being bankable to being borderline unfinanceable. The creditors and lenders react logically. A bank will not lend into a building with known systemic defects without extra security. A valuer will not certify value that fails to account for known levies or the possibility of further defects. If you cannot refinance, you cannot exit without crystallizing the loss. That is the heart of the trap. Owners are sometimes forced into selling into a depressed market, accepting a loss to avoid the blow of further levies or to release cash for an immediate financial emergency. Other owners remain trapped, paying levies and rates and interest on an asset that is steadily losing marketability. Understand who benefits from the opacity. Developers who sold the product during the boom have largely moved on. They are not the ones left writing the checks. The current owners are. The project financiers may claim rights, but often they are also constrained by loan covenants and liquidation timelines. Contractors who did poor quality work may be embroiled in litigation, shielded by complexity. Consultant reports are expensive and take time. Meanwhile, the body corporate limited liquidity model means the pain is socialized across owners, often hitting older or less liquid owners hardest. If you are an owner, what do you do next? Practical action is not heroic, it is forensic. Start by reading the strata minutes. Demand full clarity on any defects reports, engineering assessments, and the scope of remedial works. Does the building already have an active building remediation plan? Is there an inspection history showing repeated problems? Has a special levy been adopted? And if so, what is the payment schedule? Check the insurance schedule and recent renewal notices. How has the premium moved year to year? Ask whether insurers have imposed conditions or set sublimits. Find out whether the committee has sought quotes and whether the quotes are fixed price or subject to variations. Obtain copies of any correspondence with contractors and engineers, and if necessary, commission an independent review. These are not optional steps. They are survival tasks. Next, test your own numbers. Run the levy mathematics against realistic sales scenarios. If the levy per unit is $60,000 and your comparable sales are $520,000, what is the net position after you pay your share? Factor in realtor fees and the potential discount a buyer will demand for a building with remediation in the near term. If that net position is negative or negligible, consider whether holding is realistic. Holding can be viable if you have liquidity and the building has a credible remediation plan with reasonable cost estimates. Holding is not a plan if the remediation scope is uncertain and costs are open-ended. If you are planning to sell, disclose the facts honestly and do not hide behind silence. In Australia, sellers must disclose material facts. Non-disclosure exposes you to legal risk. The market often rewards transparency in a broken precinct because buyers price certainty higher than mystery. A credible remediation plan with fixed pricing, an insurance pathway, and warranty provisions is more valuable than vague assurances. The ideal scenario is a remediation program funded with security, clear legal obligations for contractors, and warranties on the work. Those are rare, but they exist where committees act early and decisively. If you are a potential buyer, treat cheap with suspicion. Cheap apartments in a precinct with known building issues are not bargains until you can verify the building's structural and legal health. Demand engineering reports. Ask to see the minutes and levy history. Ask about anticipated future levies and whether the sinking fund is adequate. If the seller cannot answer, walk. The market will not rescue a buyer who takes on opaque risk without a meaningful discount and a clear remediation pathway. How did we get here? The short answer is scale and speed. Many Melbourne towers were built quickly in response to demand and financing models that favoured rapid delivery. Developers optimised for yield and delivery, not durability, in every detail. Materials and workmanship that passed initial compliance sometimes failed under weather, movement, or long-term wear. When the defects reveal themselves, the remediation is rarely small. What starts as a short membrane fix turns into full roof plate replacement. What starts as a minor facade patch becomes full facade remediation. The compound cost mathematics is merciless. The longer you wait, the larger the bill. Once a certain tipping point is crossed, market liquidity evaporates. Political and regulatory responses are part of the story too. Authorities can investigate, impose rectification orders, or force remediation frameworks. But those processes are slow. They can mandate work, but they rarely provide immediate funding. They also create legal wrangles that lengthen timelines. Meanwhile, owners still face the immediate cash calls. Governments can facilitate loan programs or emergency funding, but those are usually means-tested, slow, or limited. Owners do not have time to wait for perfect policy responses. This is the broader economic lens. Higher interest rates, tighter lending, and stretched household budgets mean owner liquidity is thinner than a decade ago. Where earlier cycles saw easier refinancing or equity extraction to cover levies, the current banking environment is much less forgiving. Rates are higher, serviceability tests are stricter, margin for error is smaller. That is why repair bills that might once have been handled by refinancing are now impossibly painful. The buffer that once existed is gone. The household economy cannot absorb mass levies at scale. Now some cold, practical truths. If your building has an identified defect that requires more than a modest, manageable levy, the forward risk is not just a single bill. It is a sequence. It is emergency works, temporary fixes, an initial levy, further engineering investigations, price variations, legal claims, litigation costs, insurance disputes, and then staged remediation. Each stage adds cost and time. That is the slow suffocation process. For owners who cannot fund the initial calls, the options are limited. You can borrow more, sell at a loss, or in extreme cases face insolvency processes for the strata entity. None of those are attractive. That reality shifts the psychology of the market. Buyers become risk-averse. Investors withdraw from the precinct. Agents avoid listing high-risk assets prominently. Auctions stop producing competitive bidding. Clearance rates drop. Once the local auction mechanics fail, the backup is a private sale cycle with longer timeframes and deeper discounts. That feeds back into valuations and lender appetite. When banks mark down asset values across their book, covenant pressures can affect lenders and owners beyond the immediate building. The shock can become systemic when it hits a large enough cluster of apartments. You must also be aware of the social cost. These problems do not distribute evenly. They hurt older owners on fixed incomes who cannot afford levies. They hurt small investors who relied on rental cash flows to service loans. They hurt families who plan to use capital growth to fund retirement. The human stories are painful. Owners who worked for decades to buy a modest city asset now face the prospect of funding huge building repairs or losing equity. Those are real households with limited buffers. There are defensive strategies a body corporate can pursue that materially improve outcomes, though none are guaranteed. Early, transparent engineering reports that quantify the problem reduce speculation. Fixed-price contracts with reputable remediation contractors can limit variations and give buyers certainty. Warranties and insurance structures tied to contractors can transfer limited risk. Some buildings create remediation bonds or loan facilities that spread cost across time with formal repayment terms, which can be less harmful than a single shock levy. Sound governance matters. Proactive committees that commission independent oversight, tender carefully, and avoid political infighting tend to reach better outcomes. That does not make the problem painless, but it reduces contagion and improves lender confidence. For owners, practical steps now. Pull the strata records, commission a short independent valuation that accounts for known levies, get a legal opinion about disclosure obligations and potential liabilities. Model the worst reasonable levy scenario against your personal finances. Contact your lender now to understand refinancing risk. Talk to your accountant about the tax implications. If you are on a fixed income, Consider hardship options before the levy lands. Do not wait for the crisis to knock at your door. Prepare before consensus fractures. If you are watching and you are not yet directly affected but live near a precinct of high-density apartments, pay attention. The risk spreads via market psychology. Developers and councils will highlight remediation funds, but these are often partial. Do not assume proximity makes you immune. Neighborhood confidence is fragile. Once trust erodes, it can take years to rebuild. The final blunt truth. If the likely repair bill exceeds realistic resale value, you do not own an asset. You own a problem. That sentence is harsh because the mathematics is harsh. People who get destroyed in these apartment traps are not necessarily reckless. They are often ordinary buyers who accepted the glossy brochure, trusted compliance certificates, and assumed that low maintenance meant low risk. The data says otherwise. Low maintenance can mean deferred cost. Low price can mean hidden cost. Cheap entry can become a lifelong liability. So now a clear call to action. If you own an apartment in Melbourne, check the strata minutes today. Ask specifically about engineering reports, remediation scopes, contractor quotes, and insurance renewals. If major works are scheduled, get the numbers and run the levy mathematics against your best realistic sale price. If you notice repeated defects or multiple identical issues across units, that is a red flag. Comment below with your suburb and building type. Tell others what you see in your minutes. The more empirical ground truth we have, the better we can map the scope of the problem. Subscribe for more forensic property data. This problem will not evaporate because it is inconvenient for the headlines. It will get louder. It will get uglier. It will force hard choices on ordinary owners. If you are an investor or a buyer, make no mistake. Cheap-looking apartments in high-density pockets deserve extra scrutiny now. Do not assume the market will save you. The market often refuses when numbers get real. You have heard the warning. The rest is in the minutes. This video is general information and commentary only. It is not personal, financial, legal, or tax advice. Before making any decision, consider your own circumstances and speak with a licensed professional advisor.